channel, good evening at all the people visiting my website. The reason why I decided to make these today, I don't know if I'm going to change the title, but I was thinking doing like investments for dummies or things like that. The reason is that because today I launched my book some weeks ago. However, today I decided to go out and put it in some places so people sell it, and I'm blessed that in my neighborhood we have people that sell books, and I just asked them, will you sell my book? And they say me, yes, why not? We can try, right? My book looks very good, very sharp, so they said yes to me to try out to see if the neighbors buy it. And myself, being an immigrant in the United States, I was expecting some good things to happen. That's why we came here with this energy that, maybe something good's going to happen if we come here, right? The American dream and all of that. But then when I discovered that in my neighborhood there were people selling books, that blown my mind. It was incredible. So we're going to give a little bit of exposure before starting the video. And keep that word with you, exposure, because we're going to talk about that today. And this is basically my book. It's already in Amazon. You can acquire it. It has good price and good value related with the price. Sometimes you buy things that will make you earn money. Other times you buy books that will not make you earn money. This book is one of those that will make you earn money, and it's more valuable than what it costs. Other books, I don't know, novellas, fantasy, it could be profitable for you if it brings you happiness and good humor and all of that, but this is made to be valuable. Okay, so it's an intelligent thing to buy. But then I have this idea of making this video, invest for dummies. Why? Because before putting my book for sale with these people that sell books near my home, I live in New York City, near where I live, there's these people selling books. I was reading it, and I realized, many people is going to read this and it's going to say to themselves, wow, there's so many things to learn. It's going to be like a little bit overwhelming. They're going to discover many words, many terms, many assets that they have to learn about, right? And of course, in my book, in the introduction, to help them and make the book valuable, I give them resources like documentaries and things they can go and watch to really learn with images. If you still don't manage all those words and different assets that you have to understand, like options, stocks, real estate, and so on, tax liens, etc. So the reason I decided to make this video is because I'm going to make investments for dummies. And believe it or not, it's possible to do that, and I'm very happy to make this video today because I'm going to show you a simplified way of investing that I know is going to work. There's no hedge fund out there who can present you what I'm presenting you, because other hedge funds might have other different approaches to investing. They have a different approach, so they promote other ways of looking at companies and at investments. We think differently, and thanks to that, we're going to explain you today something that's extremely simple, and I understand that it's going to help you if you give up into studying and understanding more complex things. But the first thing I wanted to tell you is that, just to joke a little bit, is that we were waiting for you, and today, you have to take a decision, basically. And is that you have to choose which pill you want. You either take the red pill, okay, and you wake up from this dream, you go back to your reality, you don't change, and that's it, and we finish here. And you don't have to watch this video, you don't have to check my book, you don't have to learn finances, you don't have to learn anything. You just go back to what you were, to what you did, and that's it. Or you can take the blue pill, and I will show you how deep this rabbit hole goes. It's your choice. Today you have to make a choice, and there's no turning back. Just to say that before starting, to make it more funny, I got this one for my birthday. And so then, what I promised, okay, so investments for dummies. there's not investing for dummies, because if you want to take the best of the best decisions, you really need to understand how businesses work. However, there is a way that you can invest if you are investing by yourself, okay, and you don't trust nobody but yourself, which might help you, which is simply looking at financial statements. You don't have to learn how to read financial statements, you just have to understand 3-4 little things of financial statements. And the keywords we're going to use is common stock equity, common stock equity, and that's it. That's the only thing you have to learn in investment for dummies, okay? Which is basically, how do I explain it? It's like the assets minus debts. It's a little bit more complex than that, but it's summarizing is assets minus debts, which equals assets free of debt, okay? So then the second keyword you have to use is market cap. Market cap is when you go to Yahoo Finance and you see a stock, you'll see the market cap. That's the, if you grab all the shares on the last selling price of the share and you multiply it by all the outstanding shares, you get the market cap. Which means what's the value of the company if all the shares were sold at the current price. All the shares are not going to be sold at the current price because you are just buying a small percentage of the shares, which is the ones that are for sale. Then if you want to buy the whole business, you have to go to the owners. So the price is going to be different because the owners aren't stupid. They will not sell you a stock at a discount, okay? And they have different interests, and this is investments for dummies, okay? We're not going to go into very complicated things. So you have market cap and you have common stock equity. So you go to a financial statement, more precisely to the balance sheet, which is where you can see the assets and the debts of the company. And you will see that in one part you have what is called the common stock equity. And that is going to be a number. It's going to be, for example, I don't know, 600 million, or example, it's going to be 600 million. 632, it's going to be a number like that, okay? Reality is not round numbers. So it's going to be 600 million. So then, if you are buying a stock, and it's, for example, at the market cap of 200 million, okay? That's giving you a sign that you are getting into something undervalued, okay? Some businesses are undervalued because they are not doing well and they are not profitable. Other businesses are undervalued because they are ignored, and many reasons, okay? But investments for dummies will be, you go to the financial statement, the balance sheet, and you see, let's say 600 million, or for example, with a big bank was buying, they had like, how much they have? Like 30 billion in assets, it's a big bank. They were buying out, so you go to the common stock equity and then you see the market cap, and then you see that when you are buying those shares, that small portion of the business that's trading at that market cap, you're buying basically 600 million for 200 million, okay? That's step number one of 2 steps, and that's it. I'm not gonna make step 3 or 4. So basically, this is what we call 33 cents on the dollar, okay? Or if it's like 300 million to 600 million, it's gonna be 50 cents on the dollar. It means you're buying something undervalued. If this business starts releasing dividends or increasing profits, that price is gonna correct. And it's gonna be $1 on the dollar or $2 on the dollar, so it's gonna multiply by 3, by 6, in case the business do great, okay? We don't expect that as an investment fund, but this is a principle we follow. So you buy things at pennies on the dollar. But then the second thing to have in consideration is that you have to look at the earnings of the company. So step number 1, pennies on the dollar. So that means you are buying an undervalued asset. So you're doing well there. You might not have the best returns of everybody in the market, but probably you're going to do well. Your stock is not going to decrease more in price because it's already so undervalued. Okay, that's going to start to bounce out sometimes. And then the second thing is looking at the financial statements of the company. So, meaning the earnings and the profits. You don't want to buy a business that's not profitable. So you have the bar of the earnings, and then you have the profits. So usually you see two bars. One is the earnings. Let's say this is the earnings, and then you have the profits. And the bar is down this way. This means that the business is grabbing earnings, but is losing money. Okay? So you want to avoid that, of course. You want to buy businesses that are profitable. So they look like this. Earnings, and then a chunk is profits. Okay? And then if you can get a business where this is stable, that for many years they've been stable, okay, that's great. If there's a business that's looking like this, that's the earnings are increasing, that's even better. However, you want to buy a business that is profitable and the earnings look stable or increasing or maybe decreasing, but they always like get back in business and they keep accumulating assets and cash in that bank account. Okay? And when a business is at 33 cents on the dollar, it means that if they are paying dividend, they have enough money to pay you all the money you invested. 3 times. That then comes the dividend. If the dividend is 10%, means it's going to take 10 years or less if it increases for you to recover your money. Okay? But this is basically investing for dummies. This is a very simple way that if you're investing by yourself, you can know if you're getting into something that's reasonable or something that is unreasonable instead. Something that is like overvalued, that's too classy, too beautiful, and people is paying crazy prices, okay? Going back to the earnings, and that's the last thing, you have something that's called PE, means price to earnings ratio. So if the price to earnings ratio is 8, 10, 20, that means you're buying something overvalued. If the business is undervalued, it has nice metrics, and also has a PE of 2, 3, 4, it means you're taking a good decision. You're buying a business that is growing 20% a year, 25% a year. And if they increase profits, they're going to grow even more. So this is basically investing for dummies. This is basically investing without a lot of complications. I hope this is a good addition for my book. In my book, you are going to discover many things you can study and many things you can use to discover the best investments out there. Like the ones that grow the most, the ones that have the better exposure, okay? But this is a way for you to manage yourself, okay? And to never invest in something that doesn't look like this. If you're not using advice, if you are not learning before doing anything, okay? As Warren Buffett said, I think, it's like risk is simply not knowing what you're doing. You have many businesses like this nowadays. My fund, we recommend many, but we invest in the best. That's how we keep our high returns. But use these principles and you will find many businesses. Some even pay dividends and it's great. So the last word I wanted to say, it was exposure. You remember I told you I was giving exposure to my book, showing it in this video? That's a key word. Exposure. Why exposure is so important? Stocks is an asset that have high exposure because you're investing in people, you're investing in ideas, you're investing in industries, okay? For example, in real estate, when you buy land, when you buy properties, the only exposure you have is perhaps you buy a piece of land because you want to buy 4 apartments, right? And the land is worth X. But then in the future, that land is worth much more because someone wants to build a skyscraper or a big building with multiple apartments. So then the value of your land went up in price a lot because now that land can take much more rent. But that's the maximum exposure you will have in that type of investments. That's the maximum exposure. You're not going to go very far. When you buy stocks, you're buying brains, you're buying ideas, you're buying people. Meaning that if you own a stock, and the team of that company invents something brilliant or come up with the last software for this or that and they sell it a lot, all that exposure is going to make your money grow. And your money has no limit in that sense of how much they can grow, unless you invest in boring businesses that is hard to grow them, like Costco or hotels or all of that. That's why tech companies did so good. Investors who got into tech companies or other type of companies, they had enormous exposure to growth, and some of them grew a lot. Okay? So that's the last thing I want to share with you, the word exposure. I mentioned that in my book a lot. So in case readers of my book didn't learn the word because it's mixed with so many other concepts, I hope you can remember it with this video. Exposure. And then, last thing, and we finish, remember, I say again, investing for dummies. Common stock equity, buy undervalued, and then look for earnings. Don't buy companies that aren't profitable, unless you know that they're going to become profitable. But you don't need that. You can buy businesses that already are profitable and even distribute dividends. Okay? So that's it. Thank you for watching. Pleased to talk with you. And remember, from the two pills, I hope you chose the right one. You know, myself, many years ago, I took the blue one. I wanted to wake up. So I hope you can wake up too. And this was valuable and useful. The same for my book and anything I do. So thank you for watching, and goodbye.